I'm going to cover Chapter 3 in this presentation, which starts in the text on page 110. This chapter is going to cover steps 5 through 7 in the accounting cycle. If you'll remember, Chapter 2 covered steps 1 through 4, which were Step 1, analyze transactions, Step 2, journalize transactions, Step 3, post to the ledger, and Step 4, prepare a trial balance. So basically, we're going to complete the accounting cycle in this chapter. So the first thing we're going to discuss is cash versus accrual basis of accounting. If you're using cash, revenue is recorded when cash is received, not necessarily when it's earned, and expenses are recorded when cash is paid out. So the key here is that everything wraps around when cash is coming in and going out. It doesn't have anything to do with when it's earned. The problem with this type of accounting is it doesn't link recognition of revenue and expenses to the actual business activity, but rather when cash is exchanged. It could possibly be used by a very small business. I was kind of trying to think of a few examples, and one that kind of popped into my head was possibly if you ran a lemonade stand, you might use the cash basis. In accrual accounting, on the other hand, revenues and expenses are recorded as they're earned and incurred. It doesn't really have anything to do with cash or when cash is paid. So for example, when I was at Upchurch, I could bill a customer in December and I might not actually get the check or the cash until January, but that revenue was recorded in December on my books. It's a better measure of a firm's performance than cash basis, and it's also required by the GAAP. So, to review, cash basis transactions are recorded and revenues and expenses recognized only when cash is received or paid. And in the accrual basis, revenues and expenses are recorded as they're earned and incurred, not necessarily when cash is received or paid. And accrual provides a better measure of income, and this is what the majority of companies use. So, here's an example just to kind of demonstrate the difference. Bond Consulting billed its clients for $48,000. On December 31st, it received $41,000. The remaining $7,000 was going to be received next year. Same with the expenses. There were $31,000, but $3,000 of those hadn't been paid out as of December 31st. So look at the bottom of the screen. On the cash basis, you had cash receipts of $41,000 because that's all the cash we'd received, and we'd paid out $28,000, which was the $31,000 less the $3,000 because we weren't paying out the $3,000 until next year. So we showed an income of $13,000. On the other hand, if you look at the accrual basis, revenues earned were $48,000, the expenses were $31,000, so our income was $17,000. So it shows a more accurate picture of what our actual income was. There are three key elements of accrual accounting, and the first of those being the time period assumption. Basically, what this does is allow a company to divide operation into time periods, and that satisfies a user's demand for information. A lot of times, or most of the time, activities within a business affect more than one time period. The second is, when do we recognize revenue? So with the revenue recognition principle, it's recognized, 1, when the earning process is substantially complete, and 2, cash has either been collected or collection is reasonably assured. So basically, my example again when I talked about at Upchurch, when I would bill them in December, I counted that I earned that revenue in December even though we weren't going to get the cash until January or February. And the reason being is that basically we had finished the work and that it was a reasonable assumption that the company would be sending the check to us. So therefore, that's when we recognized the income. And the matching principle is the third one. And all costs and expenses incurred in generating the revenue must be recognized in the same reporting period as the related revenue. So again, remember that this doesn't have anything to do when cash is paid. It just has to do, if you recognize the revenues, then you have to recognize the related costs and expenses. And this is very important because in this chapter we're going to talk about adjusting entries, and that's why we make adjusting entries, because we have to recognize those expenses or those revenues in the same time period. If you look in your textbook on page 113, there is an example of applying the principles in 3.1 that you may want to take a look at. That'll maybe explain these a little bit further. Also on page 112 it talks about some ethics that are involved and some abuses that have occurred recently, and why it's important that you maintain your ethical standards. Okay, adjusting entries. These are entries that are required at the end of each accounting period to adjust the accounts to their proper amounts. Students typically have a lot of problems with adjusting entries, and so my suggestion is that you really take a look at the 4 different types, and some of the information you just, no kidding, will have to memorize and practice. Each adjusting entry involves at least one income statement account and one balance sheet account. That's why it's so important that you know that on the balance sheet you've got assets, liabilities, stockholders' equity, and on the income statement you've got revenue and expenses. Because when we get ready to make adjusting entries, if you can figure out one or the other, if you can figure out an income statement account, then you know that the next entry is going to be a balance sheet account, and it kind of helps you figure it out. Also, again, use T accounts to help decide the adjusting entries, because that can help you kind of figure out if your adjusting entries are in balance and what accounts might be affected. Another thing, remember, cash is never affected by an adjusting entry. So you should never make an adjusting journal entry that has cash as one of your accounts. So look at the example on page 115. You have 3 different situations. This is the example 3.2. So take a look at that and review and look at the 3 steps that are involved. Basically, you have to identify the accounts that are involved. Remember, one will be an income statement account, one will be a balance sheet account. Step 2 is to calculate the amount, because you're talking about partial years, so you'll have to figure out how much of that is involved in this adjusting entry. And the 3rd step is to record the journal entry, just like you record any other journal entry. These are posted just like any other journal entry. There's nothing different about that. So take some time and look at that example on page 115. Okay. The difficulty with adjusting entries and why students really struggle with these is because the need for the adjustment isn't triggered by a specific event. So you don't get a receipt, or you don't get a bill, or you don't get cash. There's nothing that triggers this event. And it's recorded on the basis of an analysis of the circumstances. So you basically have to look at what's going on and what you know about your business and figure out what adjusting entries have to be made. So there's actually 4 types of adjustments. 2 for accruals, 2 for deferrals. There's accrued revenues and accrued expenses. These 2 types of adjustments have no original entry, which we'll get into a little bit. And then the unearned revenues and prepaid expenses, which do have an original entry, and I think that that makes them easier because of that original entry. So, again, you have to determine the amount recorded for all assets and liabilities are correct. If not, you debit or credit the appropriate asset or liability count. Basically, you're fixing your balance sheet. Or you determine what revenue or expense adjustments are required as a result of changes in recorded amounts of assets and liabilities. Basically, we go back to step 1. So you debit the appropriate revenue or expense account. Basically, what you're doing there is you're fixing the income statement. So let's first talk about accrued revenue. Accrued revenue is revenue earned but not yet collected. It's receivables in the future, so should be recognized as an asset because it is money that you will be getting in. And you enter it into the general journal and post to the accounts in the general ledger just like you do any other type of an account or any type of journal entry. And it's usually a receivable. So here's an example. They earn rent revenue of $500, but they're not going to receive payment until January 10th. But it's actually rent for 2009. They know that, so they know they have to get it on their books. So basically, the original entry, there isn't one. But to correct this, they put a rent receivable of $500 because they're going to receive that in the future. And the credit would be rent revenue. Rent receivable is an asset and appears on your balance sheet. Rent revenue is an income statement account. So therefore, you have one balance sheet, one income statement account. Okay, so if you look at the accounting equation, assets equal liabilities plus stockholders' equity, you've got your assets increasing by $500, and you've got your stockholders' equity increasing by $500. Now, on January 10th, when this is paid, what would be your entry? Think about it for a minute. What we would do is we would debit cash for $500 because we actually do have cash coming in then, and then we would credit rent receivable. So the receivable account is really just kind of like a holding account for money that's going to be coming in at a later date. Your second example is an accrued expense. It's expenses incurred prior to being paid or recorded. So you know, based on the matching principle, if you have revenues, you have to have the expenses in that same time period. So this is an expense that you know you have, but you haven't paid it yet. If you don't record it, net income will not reflect the appropriate expenses, and the corresponding liabilities on the balance sheet will be wrong. So basically, this is usually a payable because, again, you're holding that money to be paid later. Okay? So here's an example. They have property taxes of $1,000 in 2009, but they decided they're not going to pay this until January 5th, which is possibly when it's due. Okay? But you know that it was for 2009. So therefore, there is no original entry here. You're going to debit property tax expense, which is your income statement account, for $1,000, and you're going to credit property tax payable of $1,000, which is kind of like a holding account where that money is going to sit until you actually pay it on January the 5th. So if you look at your accounting equation again, assets equal liabilities plus stockholders' equity. You've got your liabilities increasing and your stockholders' equity decreasing because of the expense. So when January 5th comes around and you pay it, you're going to debit property tax payable and you're going to credit cash. Again, when you're making an adjusting entry, cash is never an account that you would use. Okay, the third one, prepaid expenses. Payments made in advance for items normally charged as expenses. One that's typically made is when they're paying insurance premiums. They pay them for 6 months at a time. So maybe you pay for a year at a time. So you make the payment in July. So part of those expenses should have been in 1 year and part of those expenses in another. Okay? Theoretically, every resource is an asset temporarily. The original entry will debit the asset and credit cash, and the adjusting entry will debit the expense and credit the asset. So here's an example. $3,600 for a year of rent in advance in July. Okay, so we do make an original entry in this case. We debit prepaid rent, which is an asset, and credit cash $3,600. The reason prepaid rent is an asset is because you're kind of holding that money there. If for some reason 1 month into the insurance premium you decide to cancel that insurance, then you get that money back. So therefore that money is not really spent until every month that goes by and you've spent that much of the insurance premium. So at the end of the year, on December 31st, you have to make an adjustment to account for whatever time period you have used up, basically, the insurance. So we made it easy. In this case, it's July 1st. We've got 6 months. So we would divide it by 12, take it times 6, and that's $1,800. So we would debit rent expense, which is our income statement account, and credit prepaid rent to take it out of our asset account. Okay, and I gave you one more example here because this is a common one of supplies. So basically, supplies were purchased for $350. Supplies is an asset account, and when you purchase supplies, they come into a company as an asset, and then as you use the supplies, you take them out of that asset account and put them into the expense account. So when we originally bought the supplies, we would have debited supplies for $350 and credited cash for $350. And then what it's telling us is that we have $225 of these remaining. So we have to figure out, well, what supplies have we used? So we would take the $350 minus the $225, which gives us $125 is what we've used. So we debit supplies expense on December 31st for $125, and then supplies for $125, which brings us down, if you look at the T account on the screen, our correct balance is $225, which is where we wanted to land. Okay, the last one is unearned revenue. Cash amounts received before they've been earned. So sometimes customers want to pay in advance, and so all of a sudden you get all of this money, but you haven't actually earned it yet. So therefore, it's considered a liability because, again, if your customer changed its mind and wanted that money back, you would have to pay it back. So therefore, it's considered a liability. You don't include it on the income statement. Unearned revenue is a balance sheet item because it's a liability, and students often mistake that and put it on the income statement. Okay, so here's an example. They received $3,600 for a year's rent in advance. Okay, started in July and goes to June 30th of the following year. Your original entry is cash is debited for $3,600, and unearned rent, which is a liability, is credited for $3,600. So at the end of the year, you've earned 6 months of that rent. So you would figure out what that amount was, and this time is easy, it's $1,800. So your adjusting entry would be to debit unearned rent for $1,800, which is a liability, and would reduce that account to the right amount. And then we've earned that revenue, so therefore rent revenue would be $1,800. If we didn't make that adjusting entry, then our revenue is not accurate on the income statement. So it looks like we have less revenue than we actually have. So, to remind you, adjusting entries do not involve cash, and each adjusting entry involves a balance sheet and an income statement account. I think the last two are the easiest because they have that original entry, which kind of reminds you that you need to make that adjustment, and the first two don't. So, also, one of the things on page 122, we talk about depreciation, which actually we're going to cover more in Chapter 7, but they're kind of just introducing it here. They're talking about the contra asset account accumulated depreciation. So a contra account basically have a balance that is opposite of the balance in the related account. So for example, in this case, it would be opposite of the asset. So it would have a normal balance of a credit. And then look at the entry that you would make. You would do the depreciation expense would be the debit, and accumulated depreciation would be the credit. So you might take a look at this. Like I said, it's going to be covered more in detail in Chapter 7. This is the effects on the financial statements of each type of adjusting entry. So you can kind of look, an accrued revenue will increase an asset, increase stockholders' equity, and increase revenue, and on and so forth. So you can take a look at that. Okay, then we've got step 6. We prepared the financial statements. So basically you completed adjusted trial balance. This is completed exactly like your other trial balance was. You're going to post all the adjusting entries to the accounts, get the balance, and then you're going to make sure that your debits and credits equal. And then you're going to complete the financial statements, the income statement, retained earnings statement, and then the balance sheet. There's a really good example in the book that starts on page 124 and goes to 126. And so if you want a little bit of additional review, I would suggest that you go over that example. And then if you look at page 129 in the text, it talks to you again and reminds you about how the financial statements all tie together. That you have to have the income statement to get your profit or loss to figure out your retained earnings balance, and you have to have your ending retained earning balance before you can complete your balance sheet. So it'll show you again how all of those ties together. Now, the last thing we do, step 7, is we close the accounts. We have permanent accounts and temporary accounts. And if you think about this, it makes sense. Our permanent accounts are our balance sheet accounts. So it's our assets, our liabilities, and our stockholders' equity. You would not want to close out these accounts. For example, that's our cash account. You're going to want that to carry forward from year to year. On the other hand, the temporary accounts are our income statement accounts. So there are revenue, our expenses, and then also our dividends. You do want to close those out because you want to look at those for a period of time. So every year you want to start over with revenue. You don't want to carry it over from the previous year. So to close an account, sometimes students make this much harder than it has to be. It's really fairly simple. You close the temporary accounts, which are income statement accounts and dividends, to income summary. You make the journal entries to zero out the accounts, and then once you've got it all zeroed out, all of your revenue and all of your expense accounts, then the income summary is closed to retained earnings. And then the next thing is you close dividends to retained earnings, and then you post all of these entries to the ledger, and when you get done posting, all of your revenue and all of your expense accounts should have zero balances. So, for example, If you were closing revenue, revenue has a normal credit balance, so you would debit revenue and credit income summary. Expenses have a normal debit balance, so you're going to credit your expenses and debit income summary. When you get to this point, the balance in the income summary account should match what you're showing as net income on your income statement. If it does, then you close income summary to retained earnings. And then you close dividends to retained earnings to finish it up. Okay, so once you've done that, then all your revenue and expenses should be closed and your net income should be into your retained earnings account, which is where you want it. So, to review again, we've got 7 steps in the accounting cycle. We've covered each one of them. In class, we'll be going over more examples of how to do these things. Be sure that you complete the multiple choice exercises that are at the back of the book. Those are listed on the assignment. I think they start on page 142 to earn your participation points for class.